Good morning and welcome. Thank you for tuning in to another one of our webcasts. As always, this is your chance to ask questions to our Chief Investment Officer. My name is George Mitton and I'm the investment writer here at Nutmeg. As usual, I have James McManus, the Nutmeg CIO, Chief Investment Officer, here at the other end of the line. He's going to give us a short presentation this morning. This month, it's going to be about dividends, partly about dividends anyway. And he's given us that topic in light of the news that a number of big name listed companies have suspended dividends amid the coronavirus crisis. So I'm curious to know what James thinks that means for our investments. After that, we'll move into the Q&A session. As ever, if you've not submitted a question yet, or if something occurs to you while James is speaking, then pose it to us using the Q&A feature here on Zoom. We'll try our best to answer it today, and if not, we'll put it on the list for the next webcast. This webcast is being recorded, and that means that it will be available to watch again if you like. You'll also be able to share the link. That will be posted on YouTube either today or tomorrow. If you're not a customer of us and you're interested to learn more, then please welcome. My colleague Cully Samra would be happy to speak to you personally to answer any questions you might have. That's enough from me. I'll now introduce James. Over to you, James.
Thanks, George, and good morning, everybody. Thanks for joining us again for this webcast, and thank you, as always, for trusting Nutmeg to manage your investments. A relatively short agenda this week to ensure we get to as many questions as possible, but here's what we intend to cover. Firstly, a look at the major developments in markets over the previous 2 weeks since our past webcast. And then we'll look at the topic of dividends, as George suggested. You know, this is a theme in some of your questions over the past couple of weeks. What is happening with dividends? Do we own them as part of our strategy? What's the outlook for dividend paying companies? So I'll try to tackle those questions and more in just 3 short slides. And then finally, we'll talk about a number of small changes we've made to portfolios in the weeks since our past webcast before we move on, as always, to answer more of your questions. So let's get straight to it. What has been happening in financial markets in the past couple of weeks? Well, it's really been a positive 2 weeks across the board for financial markets, but particularly for developed stock markets and for riskier fixed income assets such as corporate bonds. Global stock markets have risen around 4.3% since our last webcast, led by Europe and the US stock markets, whilst emerging market equities actually have delivered slightly negative returns. One standout performer over this short 2-week period has been US small cap, up around 10% in the 2-week period. And meanwhile, government bonds, as you might expect when equities have performed very well, are largely flat over the period, whilst corporate bonds have delivered slightly positive returns, up around 50 basis points, 0.5% in the UK. And as I said before, riskier fixed income assets have delivered greater returns than that. So around 2% for high yield bonds, those riskier corporate bonds, and around 3.5% for emerging market debt. Outside of those traditional asset classes in the commodities market, the crude oil has continued its recovery, up around 22% in that 2-week period. Brent crude now at a price of around $35 a barrel. Closer to home, the UK Treasury sold government bonds with a negative interest rate for the first time. So despite the Bank of England stating that it's not planning or contemplating negative interest rates only a couple of weeks ago, the last week actually saw the Governor of the Bank of England, Andrew Bailey, confirm to MPs that the bank was actively reviewing the policy implications of negative interest rates. And that's, you know, shouldn't come as too much of a surprise. Policymakers are going to make sure that they explore all the policy tools that are potentially available to them, even if they, you know, are unlikely to use some of those tools in the short term. But the UK sold, the UK Treasury, in fact, sold 3.8 billion sterling of negatively yielding 3-year government bonds. So that's investors paying for the privilege to hold that debt to maturity if they do indeed hold it to maturity. And of course, negative yields are nothing new in Europe. We've seen that in European government bond markets for some time. And in fact, actually negative real yield, so the yield after inflation, is nothing new for government bond holders in developed markets, particularly in the UK. But this is the first time the Bank of England has actually sold bonds at a negative yield. So will the Bank of England go to negative interest rates? Well, you know, we know that interest rate cuts have a lagged effect on the economy, and therefore policymakers, I think, will be in no rush to venture into negative rates should they consider it, you know, a sensible approach. I don't think that will stop the market potentially talking about negative interest rates or taking existing bond yields into negative territory. We did see the UK 5-year bond move into negative territory last week. It's since come back into positive yields. It's likely that we'll see negative bond yields if we think that if the market thinks that that's the direction of policy, but I don't see this as something that the Bank of England is going to rush into in the short term. In the US, we've seen the Senate pass a bill that could lead to the delisting of some of the foreign companies from US exchanges. Now, this is a bill that requires companies to follow US standards for audit and for other financial regulations, and to also reveal ownership by foreign governments. And it's been passed by the Senate, but it now has to be passed by the House of Representatives before being signed into law by President Trump. And the interesting thing about this bill is it appears very targeted at China specifically, and it follows an increase in criticism of Beijing by US officials in recent weeks, and follows the announcement, of course, of the imposition of those security laws in Hong Kong. And the political tensions really that were present pre-COVID certainly show no signs of de-escalation post-COVID, if we can say that we're at that stage yet. And even late yesterday, President Trump also announced further action this week that's expected to come out in response to the imposition of those security laws in Hong Kong. So something that could really further escalate tensions there. And that's something that investors are going to be keenly watching as we progress towards normalization of economies and reassessing some of those trade discussions that were happening pre the lockdowns. Meanwhile, some good news out of Europe is that the European nations appear to be making some progress on a further support package for their economy. France and Germany have jointly proposed a 500 billion EU recovery fund. This is where the European Commission would raise funds externally in public markets and then would distribute those via grants to the most affected sectors and regions. And that raises the prospect of a response that's funded at a common level. And that's been a real sticking point so far. But the key part of this plan would be that it would be funded at a common level and would be seen as part of the EU budgetary expenditure. However, with any of these stimulus packages in Europe, we are likely to see a familiar sticking point, and that is that all the EU governments will need to agree for any plan to take effect. And we're already seeing opposition to this or opposition at least to some of the details in the plan by Austria, by the Netherlands, by Denmark and Sweden, who over the weekend actually announced a counter proposal that eliminates the pooling of that debt. So, the EU Commission is set to table final detailed plans this week. Meanwhile, the ECB is actually rumored to be considering an expansion to its pandemic purchase program. It is likely to see opposition, and we are likely to see some of those details continue to be refined in the weeks ahead. But hopefully, that is a sign of progress there in Europe, that the European nations can collectively come to an agreement on further stimulus. The macro data, meanwhile, in the past couple of weeks have continued to show a deep slump in activity, as we've expected. We've had a lot of business activity surveys over the previous week or so, and the headline really is that they've showed exactly what was expected. Business surveys in the US showed sharp contractions in both manufacturing and service sectors. There were some improvements actually in the Eurozone and the UK business activity survey readings in May. But really, they only served to demonstrate just how depressed activity had been prior to that. And all readings were still firmly in contraction territory. So still in contraction, not as bad as the prior readings, but still not an overly positive environment or a positive sentiment coming through from those surveys. Meanwhile, in the US, we also had existing home sales. We also had a retail sales number that saw large declines. And we saw that US consumer spending fell by a record 7.5%. So, on the whole, macro data as expected from the current environment, showing a real deep slump in activity. And then finally, investors will still have a keen eye on labor markets and how temporary the spike in unemployment that we've seen in developed markets will be as we begin to normalize economies. And last week we saw an initial jobless claims figure in the US of 2.44 million. That was in line with expectations, but it brings the total number of individuals that have filed initial jobless claims in the US now to over 38 million individuals since the start of this crisis. So, investors are really going to have a keen eye on the continuing claims numbers in the next couple of weeks. And that's the number of ongoing unemployment insurance claims in the US, and that's going to be a key benchmark for the depth of the normalization that's underway in the US, and investors are really going to want to see that continuing claims number drifting lower. In the UK, we also saw a spike in the jobless claims data for April that was released last week. That increased by nearly 70%, the most since records began, to reach a figure of 2.1 million. What's also concerning in the UK is that the number of individuals furloughed under the job retention scheme is continuing to rise. So as of May 10th, which is the latest data point we have for that, the latest number stood at about 2.5 million individuals. So over double the figure from 3 weeks earlier. Policymakers are going to be really keen to ensure that normalization is well underway before that scheme expires, to prevent a further spike in claims or any further unemployment coming from individuals rolling out of that furlough scheme. So now we're going to move on to a topic that many of you have been asking about, and one that has increasingly been of the headlines of late with the financial press, and that is dividends. And thanks here to both Robert and Ibrahim, who've both sent in questions on this topic last week. Now, many of you will be familiar with stock dividends, particularly if you rely on an income from your investments. Dividends are an important part of the return characteristics of many equity markets. They can be a very appealing aspect of investment in a given stock or sector, or in fact region. And a dividend is essentially a share of the company's profits that are distributed regularly to shareholders, and they can help smooth the investment journey, because whilst the price of shares can increase or decline in the short term, or in the long term, in fact, companies that pay out dividends are allowing you to sort of bank some of that return along the way. And that provides a natural income for those who require it. But it also allows you to adjust an asset allocation naturally and to maximize the benefit in the long run. It's really important also that investors consider reinvesting those dividends. And because dividend payouts, come at the expense of reinvesting for growth, many established dividend payers tend to be mature companies. They tend to be companies that investors are attracted to by the stability of their dividends over time, and by the tendency of those dividends to grow year on year. And in fact, with interest rates so low over the previous decade, many investors have looked to stable dividend paying equities as a source of income, potentially ignoring the slightly higher risk profile in equities in search of that higher yield. However, the current environment doesn't really discriminate across companies or economic sectors, and the uniquely challenging economic backdrop has meant that many companies are being forced to reassess whether it's prudent to reward shareholders in the short term in lieu of retaining cash in the business or investing in their business or in their employees. Now, clearly, the lower for longer interest rate environment that we're in will force investors once again to search for those yields that are available outside of lower yielding fixed income and cash assets. But this means that actually that in the current environment, a record number of companies are actually doing something that ordinarily would have seemed quite unthinkable, and that is reassessing dividend payments and focusing on cash preservation at this time of crisis. And this threatens to leave dividend investors high and dry. One of the main reasons driving the choice of a company's selection is disappearing here as companies cancel dividends, and the extent of cancellations is really quite high. And in the UK, over 300 companies have now cancelled their dividends so far in 2020. That's payments totaling over 30 billion to investors that have been cancelled so far. And amongst the most high profile are many companies that have considered to be, amongst the most reliable dividend payers in history. So Shell, for example, who have now cut their dividend for the first time since World War II. BT have also suspended their dividend. That's the first time in 36 years they've had to take that action. And Imperial Brands, the tobacco maker, has also suspended its dividend for the first time in 24 years. So what we're seeing is some really stable dividend paying companies that investors have relied on over the long term for dividend growth and also stable dividends, having to reassess their dividend policies and reassess what payments can be made to shareholders in the current environment. So does this matter if you're not an income-seeking investor? And the simple answer to this is yes, it does. It matters a lot, and that's because dividends matter a lot to most equity investors. And the level of dividend income differs, significantly between geographical stock markets, depending on their their economic makeup. So some industries will naturally be more mature than others. That will lend itself to making dividend payments, much more naturally than immature growth sectors do. But it's also, also lends itself, certain industries are also better suited to stable payouts based on recurring stable revenues. So, for example, utilities. But over the long term, dividends have accounted for a significant portion of broader equity investors' returns, particularly when they've been reinvested. And in fact, dividends have accounted for a substantial portion of equity returns in the US, in Europe, in the UK stock markets over the long run, particularly when dividends are reinvested back into the companies from which they've been received. And I've taken the example here of the UK, and this is a market that pays a relatively high level of dividend income relative to its global peers to really demonstrate the importance of dividends over time and the importance of reinvesting dividends. So we've often talked at Nutmeg about the power of compounding returns in long-term investment. That is the additional returns that can be earned when previous returns are reinvested. But I think dividend investment, or dividend reinvestment rather, is one of the greatest examples of this. So this is a chart from 1990, and since 1990, the price return, that is the capital appreciation alone of FTSE 100 stocks, has resulted in returns of around 143% to the end of April 2020 for investors. But the total return of those stocks, and that is accounting for the dividends that were received and reinvesting those dividends over that same period, would have been 678%. So as you can see in the chart, the price return of the FTSE 100 has actually been quite muted in the long term. In fact, the current price is below levels it reached in 1999. But that doesn't mean investors that invested in 1999 have suffered a negative return if they've reinvested their dividends. So from the end of April 1999 to the end of April 2020, the price return for the FTSE 100 alone was actually negative 9.94%. Yet the total return, so that's including those dividends that you've received and that you've reinvested, was actually 88.47%, so 3% per annum annualized. And hopefully that helps demonstrate to you how important dividends are and how important the reinvestment of dividends are to total returns in some stock markets over the long term. So it's not just income investors that will suffer in the near term here, but equity investors as a whole will be concerned around dividend cancellations. So I guess, in summary, dividends are critically important in the long run. Income is clearly a really important part of the return mix for any investment portfolio. But at Nutmeg, we prefer to see dividends as just part of as just that. So part of the overall return mix, but not the absolute focus. We're not focused purely on income at Nutmeg. We're focusing on building portfolios that leverage both growth and income to deliver returns in the long run. And one of the aspects actually that we haven't liked about dividend focused strategies in some markets over the previous 5 years has been the chasing of high income companies, the chasing of companies that paid high dividends, and the crowding of investors into those dividend stocks in search of higher yields, given so many investors require an income for their portfolio. So as bond yields have been so low for so long, investors in search of income have been forced to consider dividend equities as a source of that income, and consequently they've taken more risk to do so in order to do that. And what we've seen actually is the crowding of investors into the same company, and we've previously described it as chasing income, which in itself creates risk through a lack of diversification. We've looked at the past on Nutmegonomics at how the largest holdings of many income funds have often looked very similar over the previous 5 years. So this is a risk we've been quite concerned with. And it's one of the reasons we've held less dividend strategies over the previous 3 years or so. But we think the current environment also presents a really unique challenge for dividend-focused investors. Dividend stocks are often seen as a defensive asset, as an asset that offers more stability through the business cycle. But we think the unique nature of this crisis really means that few sectors have escaped unharmed. And we think this is a particular issue for UK equities as well at the moment. And for many global investors, the level of dividend yield in the UK market is a very attractive aspect of the UK market. But with around half of that yearly yield coming from just 10 stocks alone, including the likes of Shell and HSBC, who have already cut those dividends, the impact of those cancellations is going to be significant. if only temporary. And of course, there are other concerns for UK investors too, chief among them Brexit, and also the weakness in GBP, given the extent of overseas revenues that large cap UK companies derive. So, the major question here really is very similar to that of the wider economy, and that is, how long will it take to normalize? How long will it take to reinstate a lot of these dividends, and how long before businesses feel comfortable with the operating environment and are able to normalize dividends? And unfortunately, when we look at past occurrences of significant declines in dividends, they're very few and far between. The global financial crisis is the one that stands out in recent memory. When we look at all other dividend bear markets, that's when dividends have fallen more than 20%. They have all actually taken place in the pre-war era, outside of the global financial crisis. All other dividend bear markets have taken place in the pre-war era. I think overall here our view is we're unlikely to return to sort of a business as normal environment in the near term. There's also the chance here that policymakers may prevent businesses that have utilised government support mechanisms from paying dividends in certain regions. We're seeing that in the UK, where banks have been prevented from paying dividends. But as the economy normalises, companies that have been known to be those stable dividend payers over time, companies that are known for that dividend aspect, and that's part of their core appeal, will want to ensure that they can reinstate dividends as soon as possible. But that's also going to rely on normalizing a normalized economy, allowing them the environment in which they feel comfortable that they're able to do so without harming their businesses. So, in summary, dividends really important in the long term. We do not currently own any strategies with an explicit dividend focus in our portfolios. We think the short-term outlook for dividends is very challenging in the developed markets. We do have a natural level of yield in the portfolio, from our equity exposure, and that's obviously important to equity market returns. And in our view, now is not the time to be buying dividend-focused strategies, but actually rather to be focusing on which assets are going to perform well in the recovery environment that we have ahead of us. And as we've spoken about in recent weeks, some of the shifts that we've made in portfolio exposure have been focused on just that. So I guess finally on that topic, a quick word on portfolios. As always, we've continued to manage portfolio exposure actively over the previous month. And here are a number of small changes that are worth noting over the previous couple of weeks. So we've actually moderated our view on US NASDAQ stocks slightly. We remain overweight here, so we retain a holding that is higher than that we typically expect to hold over the long term, but recognizing the really strong outperformance of other markets since the market recovery began in March, both regionally and internationally, we started to rebalance that position, and therefore we've cut our overweight in those stocks by about 25%. And so that's really a reflection of the risks of other investors crowding into these stocks, but also the strong performance that they've delivered thus far in the market recovery. We've also continued to increase exposure to SRI-focused strategies in the Nutmeg fully managed portfolio. So, as discussed in previous weeks, this is a long-term theme that we are embedding in our portfolios that speaks both to our preference for a heightened exposure to companies with greater environmental, social, and governance alignment, but also a lower overall carbon exposure. And the proceeds of the NASDAQ rebalance have been invested into socially responsible focused strategy focused on global equities, all country global equities, so that's both developed markets and emerging markets. And we've also actually introduced European exposure specifically focused on socially responsible portfolios within our European equity exposure. So in aggregate now, this means that the typical Nutmeg fully managed portfolio has on average around 15% exposure to the SRI theme within its respective equity allocations. And that's a theme that we think is a long-term theme for portfolios that we have a lot of confidence in and that we want to continue to play. Finally, we've also introduced a new fund into the SRI portfolios themselves. So here we've introduced an ultra-short maturity credit exposure. So this is credit corporate bond exposure with less than 1 year maturity on average. Again, it's screened for social responsibility focus. So these are companies that avoid controversial activities, but are also much more aligned with environmental, social, and governance norms than their peers. And this is actually a new product that's been launched. We were quite involved in the development of this product with the provider who's launched it. And this is really going to help us balance our corporate bond exposure and also our interest rate sensitivity within our socially responsible portfolio. So we're very excited about the introduction of that fund. And we are excited as well about the introduction of potentially further asset classes in the coming months to those socially responsible portfolios. And so that really concludes the prepared slides for today. So George, maybe now we could move to customer questions.
Certainly, James. Thank you for your presentation. As always, you have underpromised and over-delivered, I thought, rather than just being a very short presentation. That was actually very thorough. So thank you for that. I certainly learned a few bits and bobs about dividends that I wasn't aware of. Certainly, I was very surprised and interested to see quite how different those two lines looked on the charts between the total return and the return without reinvestment of dividends. Clearly, dividends do matter. Okay, let's move into the Q&A. So we have a question from, before I start, I'll just say thank you for those of you who submitted questions during the presentation so far. We've had a good one from Nathan. Thank you, Nathan. We will come onto that one shortly. Just want to deal with a couple of questions that came in prior to this session. So we have one here from Cecil, who says, many are predicting a catastrophic collapse of the economy and markets. So quite a pessimistic outlook here. Does Nutmeg offer a strategy to leverage this possibility? Do you have a specific collective investment vehicle for this eventuality? So James, how do you deal with very pessimistic predictions like Cecil's?
So yeah, thanks for the question. I guess what the question here is asking is do we have a way of playing the market when it declines sharply? And I guess the first thing to say is that predictions of an imminent market collapse are always there, even outside periods of crisis. And clearly the economic outlook at the moment is very challenging, as we've discussed in detail in recent weeks, and it will remain so in the near term. And then also, clearly the performance of stock markets in particular has been actually quite strong in light of that of late. But I guess the first thing to say would be that we don't believe that we're about to witness a collapse in stock markets. We certainly wouldn't be positioned as we are today if we believe that would be the case. I've said before that outside of a material shift in the trajectory of the virus, we don't believe that we will retest the market lows of March, and that really is for good reason. Much has changed since then. We much better understand the consequences of the virus and the lockdowns on economies. We understand what the potential pathways out of the crisis are going to be, and we understand what policymakers critically are going to do to support the economy. And a really historic amount of stimulus has been pumped into global economies since the middle of February. The Federal Reserve alone has expanded its balance sheet by nearly 3 trillion in the past couple of months, and that's an astonishing amount of stimulus and support that didn't exist when markets were selling off in early March. In December, the Fed's balance sheet was around 4.1 trillion. It's now expanded to over 7 trillion. So that's a really significant input of stimulus. And it's worth remembering that, financial markets as a whole are supposedly very efficient at pricing risk. And that means that known information should now have already been considered. And what we know is that economic news has been bad, and it will continue to be bad because we know that the effect of the lockdowns is ongoing. And we also expect that economic data to get worse in the second quarter as company earnings, for the full periods of lockdowns come to light. And just be clear here, I think when we say that we don't think that we will retest the lows, that doesn't mean stock markets can't or won't fall from here. Far from it. And in fact, as we've spoken about, in recent weeks again, volatility is to be expected. And to be clear here, we do expect further volatility the world adjusts to a new normal and we open back up economies. There is no playbook for this. It is trial and error, and invariably there will be structural changes in the way that companies and sectors have to operate, and on the competitive landscape. And the data may be worse than expected, for example, in the near term. But there is a significant amount of discounting of bad news that's already taking place, and that's it's likely that the data could also surprise to the upside as much as it could to the downside, because we know the extent of the lockdowns has been very severe. On the question directly on strategies for a sell-off, one of the core principles in the way that we manage investment portfolios at Nutmeg is a focus on diversification. As events earlier this year showed, that doesn't mean portfolios are immune to volatility, but it does mean that risk is managed appropriately in order for portfolios to deliver on their long-term goals. So we don't go short the market. We don't use derivatives in our investment process. We balance the risk and reward in our portfolios by diversifying our risk and by looking to own the right types of assets for the prevailing macroeconomic environment. And balancing this risk this way means positioning for the outcome you expect, but also accepting that there's a probability of a different outcome. And so, it's really important to understand that means holding the optimal mix of assets. So that doesn't mean that every asset will always profit under your base case scenario, but it means positioning portfolios in order that the overall portfolio will do and will remain aligned to its long-term objectives.
Thank you, James. Now, you've talked a bit about what you as an investment manager is doing. Now here, this question is from Tanita, and it asks whether Nutmeg customers should be doing something. The question is, would you advise investors to amend their current portfolios to a higher or lower risk profile, given the current market conditions? So, James, should customers be adjusting their risk level?
So I think the answer here is that you shouldn't need to amend your portfolio risk level at all if your time frame or your goals haven't changed. We don't encourage our clients to change their risk levels or attempt to time the market. As I just discussed, our investment portfolios will always be positioned appropriately for what we perceive the balance of medium-term risk and reward to be, and the current market conditions therefore should have little bearing in the short term on the risk level that you opt for. This should be based really on your goal, on your time frame, on the risk appetite that you have for that goal in the long term, and that will really ensure that over the long term you're best positioned to reach your investment goals.
Thank you, James. Right, no, so now we're going to come to a question about Nutmeg's allocation to UK assets. So Nathan asked this question during the Q&A today. Nathan wants to know about the home bias of Nutmeg portfolios and wants to know if there are cost reasons or marketing reasons for Nutmeg portfolios allocations to UK assets, or whether that reflects an investment view that the investment team like UK equities. We had a similar question from Eric, who also asked us to comment on what Eric sees as outsized allocations to the UK relative to other markets. And especially Eric notes in lower risk categories, the UK seems to be outsized versus the US. So James, could you talk a little bit about the idea that Nutmeg portfolios have a home bias to the UK assets? Is that true? And if so, why is that?
Yeah, sure. So again, thanks for the questions. I guess our portfolios are constructed with both a home currency bias, so that is a GBP sterling bias that ranges from 100% in low risk portfolios up to around 25% in higher risk portfolios, as well as an across the board UK equity home bias, and that typically targets a level of around 25% of total equity exposure over the long term. And the main reason for that is that the bulk of our clients, long-term future liabilities are all denominated in sterling. And so when we construct Nutmeg portfolios, or when we first constructed Nutmeg portfolios, we ran thousands of simulations based on different levels of UK exposure, from as little as 10% through to as high as 90%. And what we derived over the past 30 years was that the best risk return risk reward trade-off was around 25% UK and 75% overseas exposure. So as a pragmatic solution, we decided to use 25% as our base long-term allocation. Fully aware there that is at the same time higher than a global equity allocation to UK equities, but also significantly lower than the typical UK investors allocation to UK stocks. So actually our current UK exposure in managed portfolios and fully managed portfolios is actually much lower than this. It's around 20% lower than that long-term target of 25%. So for example, that would mean a level of around 20% in risk level 10. For our lower risk portfolios, we've really balanced the long-term currency risk with the cost of hedging that risk, and we've incorporated that in the simulations to derive what we think is an optimal weight for a UK investor in lower risk portfolios that manages that currency risk aspect. And it's worth bearing in mind there that currency risk can be a really significant portion of lower risk portfolios, but also that the cost of hedging that risk can be quite extreme, and that can drive a higher allocation to UK equities in lower risk portfolios for UK investors, as we try to manage that trade-off between the currency risk, but also the reward levels that are required over the long term to meet the goals. So I think what's interesting in the UK investors in particular, and when we look at the typical home bias of a UK investor, is that there is quite a noticeable trend over the last 20 years of increased diversification. And the typical UK investor or the typical UK multi-asset fund would on average run an allocation of around 50% to the UK market. The IMF estimates that the UK bias of UK institutional investors is around 57%. So we're materially lower than that long-term UK bias. We do have greater overseas exposure, but also we think that the fact that approximately 70% of UK large cap equity revenues are actually derived from overseas. So the UK stock index as a whole is an index where companies are listed in the UK, but actually are deriving upwards of 70% of their revenues from overseas. And that really highlights the sort of global nature of the UK equity market and the trade-off that investors are making here.
Thank you, James. We now have a question from Roper, who is interested in the Lifetime ISA, which is one of the products that we offer. Roper has a Lifetime ISA or LISA with us and is wondering whether the government bonus is likely to be affected by the current economic climate. In a moment, perhaps, James, you can explain how the bonus works in a LISA. The reason for this question is that the government has recently changed the early withdrawal charge on Lifetime ISAs because of the coronavirus crisis. So Roper wants to know, given that the early withdrawal charge has changed, is the bonus likely to change? Over to you, James.
Okay, so thanks again. Another really interesting question, Roper. So firstly, Lifetime ISA. So for those who don't know, the Lifetime ISA, or sometimes referred to as a LISA, is a specific type of ISA that was introduced by the government to help younger people aged between 18 and 39 get onto the property ladder, or to put further money away for retirement. So in simple terms, for every pound that you contribute, the government will pay a 25% top up to a maximum of £4,000. So that means you can pay in £4,000 per year, and you can earn a maximum bonus of £1,000 on that. But there are some devils in the detail here to be aware of. So to ensure that people were using the money and in fact that government bonus that the government is offering for the intended purposes, either to buy a first home or for retirement, there was also an introduction of a penalty of 25% for withdrawing the money that you paid into a LISA to use for something else. And while on that surface that might sound like you're only losing out on the government bonus there, actually there was a small penalty for withdrawing money. So for example, if you'd pay £100 into a LISA, and the government then tops that up with £25. That leaves you with a total of £125. Now, if you apply a 25% exit penalty to that, actually you're going to pay a penalty of £31.25 to remove the funds, which is higher than the 25% government bonus you've received and eats into your initial contribution. So it's really important if you're investing in a LISA to be aware of some of the devil in the detail around how you can earn these bonuses for buying a first property or in fact for boosting your retirement, but also that you're locking up the money and there are potential penalties to pay if you then need to access that money. However, as you said, as part of the measures announced to help savers during this period of crisis, with the onslaught of coronavirus, a couple of weeks ago, the government announced the withdrawal penalty would actually be reduced to 20%. So that means that LISA customers who needed access to their savings were only actually losing the government bonus. So that's great news for those that now need to access those savings because of the current environment. Onto the question itself, there hasn't been any indication from the government or HMRC as yet that they will be altering the government bonus for lifetime ISAs at this stage. I think while nothing is guaranteed, tax rules can obviously change in the future. We'd be pretty surprised, I think, if the lifetime ISA bonus were reduced. The product was created and the bonus is there to encourage people to save and invest for big financial milestones that they have in the future, such as their first property or their retirement. And these are goals that the government is still likely to really want to support young people in achieving. So we think it's unlikely we'll see an alteration at the current stage, but as with anything, nothing is guaranteed, and we'll be the first to update customers if there was a change there.
Thanks, James. Yeah, I would just echo that. My understanding, and I'm certainly no expert here, but my understanding is that the 25% bonus that you get for paying into a lifetime ISA is effectively the same bonus that you access if you invest in a pension. It's the same as basic rate tax relief for investing in a pension. So there's a certain kind of harmony between those two regimes there. So I would imagine that for the lifetime ISA bonus to change without also accompanying changes in the pension regime is quite unlikely. But as I said, I'm absolutely no expert. That's just my observation. Okay, let's move on. I think this will have to be the final question because we are running out of time. But it is quite a topical question given some of the news that I've certainly read in the last few days, because it's about inflation. Peter wants to know, how do you see inflation behaving over the years following the pandemic, and what implications would high or low inflation have for investments? James.
Okay, so yeah, I mean, inflation is a topic that is really front and central to investors' minds at present. Just last week, the UK inflation rate fell from 1.5% in March to 0.8% in April, which is the lowest level since August 2016. And collapsing oil prices, the weak economic activity, and the lockdowns that we've seen were among factors that contributed to the decrease in the consumer price index. Meanwhile, we also saw core inflation fall to 1.4% in April in the UK. So, let's tackle the second part of that question first, and that is what implications inflation has for investments, either high or low. And the first implication is most obvious. So that is that inflation really erodes the value of money over time. Whereas, when you're investing, you're focused on increasing the value or, more importantly, the future purchasing power of your money over time. So the two are somewhat at odds to each other. Inflation is not the friend of investors or savers because it's eating into your return and it's eroding that purchasing power. In the Western world, although inflation has typically undershot central bank targets in recent years, it's still had the potential to significantly damage the long-term purchasing power of your money. This is something actually that many investors forget. And with interest rates so low, the real return, that is the inflation-adjusted return, the return after inflation, of many cash savings products, and in fact many lower risk investments such as developed market government bonds like gilts, for example, UK government bonds. Those real returns, those after inflation returns, have actually been negative for some time. So, higher inflation really means that investors are going to need to seek greater returns to maintain the purchasing power of their investments. Conversely, lower inflation actually lowers that bar, but it also increases the opportunity opportunity to earn returns, to increase the purchasing power of your money, because inflation is less of a drag on returns. There's actually an opportunity there to increase your purchasing power to a greater degree. And given that lower inflation typically also means lower interest rates, investors are often going to have another incentive there to take more risk and try and maximize return in a low inflation environment. As to where we see, inflation in the years ahead, or how we see inflation behaving in the years ahead, I think the key drivers of inflation are both structural and cyclical, and the events of the oil price collapse and the economic shutdowns following COVID-19 coronavirus are examples of structural impacts, and they're going to tend to moderate inflation going forward. And in the near term, there are likely to be many deflationary pressures are present in economies. The demand shock in major economies has driven a negative output gap. That's where actual GDP growth is much less than the potential growth of the economy. But that's expected to be temporary. This is exactly what the record levels of stimulus that are being pumped into economies seeking to correct. And this output gap, as that output gap starts to narrow as economies recover, then the more inflationary pressure there will be in the system. And near-term inflation remains a risk, but in our view, it's not a high probability. A higher level of unemployment is likely to persist for some time. Again, that's going to be a deflationary pressure, because there's less upward pressure on wages. One of businesses' biggest cost inputs. And it's also likely to take time for businesses to adjust to their new environment. So, for example, taxes may need to rise in order to compensate for the policy response as well. That's going to reduce disposable income and thus spending. And recovery in product in commodity markets is going to be linked really to the speed of the recovery in global growth. So there are going to be plenty of deflationary pressures present in the near term, but there are also some inflationary pressures on the horizon that you've also got to consider. And many of the policies introduced by central banks, in fact, during the financial crisis, quantitative easing amongst them, were expected to be quite inflationary, but they didn't really have that effect, because a lot of the cash that was injected into the economy didn't really reach the real economy. And this time around, the stimulus has been much more direct. The government spending has been targeted at the real economy, and that will bring with it its own inflationary pressures. In the medium term, we've also got to look at aspects like the US-China trade spat, the imposition of trade tariffs, the unraveling of globalization, and the increased prospect of localized supply chains or increased onshoring of production, and the increased costs of goods production that could bring. I think the depression in global trade and travel, and the effect that that's had on commodity markets is obviously unlikely to persist at current levels in the medium term. We're also already seeing, a recovery in the oil prices as economies begin to normalize. So we're seeing some of the costs of some of those key input costs start to rise slightly. And I think also on a localized level, it's worth recognizing, what are some of the structural changes we could see here, and what inflationary pressures might those bring? So, where do business models need to adjust? For example, the businesses that operate at lower capacity or lower volume, do they need to adjust prices to compensate for that? Or will we see sort of bottlenecks in production as we see supply chains disrupted as we normalize economies? Both of those could bring with them their own inflationary pressures. So, I think near term there are many deflationary pressures present. We don't think there's that. Again, we don't think there's that much room for complacency on inflation. However, not least because central banks, around the world are going to be focused on boosting it as the economy recovers, and zero rate policies is part of that. So, for us, our investment strategy really takes this into account. We're at a near neutral exposure to equities. We're overweight growth stocks in technology stocks. Government bonds are a bit more problematic in that environment, and so we have a diminished exposure to those in our portfolios at present in favour of corporate bonds that are producing or that have the potential for a higher return threshold. So I hope that kind of summarizes the view in short. That is a big topic, and we will make sure that we write about this topic of inflation on Nutmegonomics in weeks to come, and really explain our thinking in deeper detail there.
Thank you, James. As I said, that has to be the last question, I'm afraid, because we are running out of time. If your question didn't get answered, please tune in next time and we will try to answer it then. We have reduced the frequency of these webcasts as the markets have stabilized a bit. So the next one is scheduled for 2 weeks from now, and that will be at 11 AM on a Wednesday as usual. Look out for your email and on our channels to hear us talking more about future webcasts. I've mentioned before about Trustpilot. If you're a customer with Nutmeg and you've had a good experience, a great way to share that feedback is by leaving us a review. You can find the right website by searching for Nutmeg Trustpilot. The feedback is really helpful for us. I also wanted to highlight that we still have our partnership with Great Ormond Street Hospital Children's Charity going on. If you want to make a difference to ill children and young people, we will donate £25 for every Nutmeg Junior ISA account opened, and we'll also match any donations you make up to £100. You can learn more about that at nutmeg.com/JISA, capital at risk. JISA rules apply. Thanks again for tuning in, and we hope to see many of you next time.